Welcome back. Keki Mistry, the Vice Chairman and CEO of HDFC, is now ready to address the media. So let's cut in and hear what he has to say about the quarter gone by.
Our total loan book at the end of December stood at 1,92,266 crores. And that represents an increase of 19% over the previous year, the previous year being 31st December of last year, when the number was 1,60,941 crores. Now, this 19% growth is after netting off or after reducing the loans that we have sold in the last 12 months, which in the aggregate amount to 3,263 crores. So had we not sold those loans, then the growth in the loan book would have increased from 19% to 21%. Now, when we look at the breakdown of the growth in the loan book or the increase in the loan book between individuals and non-individuals, the focus continues to be on retail loans, on individual loans. So on a balance sheet basis, individual loans have increased by 24% on a year-on-year basis, that is December 2013 compared to December 2012, on a base which is obviously increasing by that kind of percentage every year. But that growth of 24% is after considering the loans that were sold. All the loans that are sold qualify as priority sector lending and therefore are all retail loans, all individual loans. So if we add back these loans, then the growth in the individual loan book would have been as much as 27%. As of 31st of December, we had a total portfolio of 16,211 crores, which are the loans which have been sold by us, but on which we continue to receive income from the customer. So the way we sell a loan, as we've explained in the past, is that at the time of selling a loan, we do not book any accounting profit upfront. So let's assume that the underlying interest rate on a loan that we have sold, for argument's sake, is 10.5%, and we have sold it, again for argument's sake, at let's say 9.25%. So the customer continues to pay 10.5% to us. Of that 10.5%, we retain, in this example, 1.25% as our income and pay the remaining amount to whoever we have sold the loans to. So that then creates a stream of income for future years. So on 31st December, we had a portfolio of 16,211 crores, on which we are currently receiving a weighted average return of 1.25% a year. If we look at the loan book outstanding on 31st March 2013 and 31st December 2013 and break that incremental growth between individuals and non-individuals, then the bulk of the growth has come on individual loans. So 89% of the growth in the loan book is on account of individual loans, and only 11% of the growth is on account of non-individual loans. Spreads, which represents the difference between lending rate and borrowing rate, for the 9-month period stood at 2.25%. If we break down that 2.25% between individuals and non-individuals, individual spreads stood at 1.97%, non-individual spreads stood at 2.82%. If we just compare with the previous quarter, so if we take the third quarter of the financial year and compare it with the second quarter of the financial year specific for the quarter, then the spreads have expanded by about 8 basis points. So incremental spreads for the third quarter were 2.28%. Incremental spreads in the second quarter stood at 2.20%. Net interest margin stood at 4% compared to 4.06% in the second quarter. But that is a natural phenomenon because as the balance sheet keeps increasing in the course of the year, the growth in the balance sheet comes on borrowed funds, on borrowed money. And there is an interest cost attached to those borrowings. So net interest margin stood at 4%. Non-performing loan, if you compare the non-performing loan number in December versus what prevailed in September, then there is an improvement of 2 basis points. So non-performing loan number in the aggregate in September had stood at 0.79%, and in the third quarter in December, that number now stands at 0.77%. And again, if we break down that non-performing loans between individuals and non-individuals, individual non-performing loan reduced further from 0.59% in September to 0.57% in December. Non-individual loans was broadly the same. It was 1.19% in December and stands at 1.18% in December. So it's a 1 basis points reduction. From a provision perspective, from a regulatory perspective, we were required to carry a provision in the aggregate of 1,357 crores, which includes provisioning on standard assets. Compared to that 1,357 crores, we continue to be overprovided, and on 31st of December, the actual provision amounts to that 1,823 crores. So we are carrying an excess provisioning of as much as 466 crores ahead of what we are required to carry as per the regulation. When you look at the asset side and you look at our investments, as you know, we have investments in HDFC Bank, HDFC Life, the general insurance company, that's HDFC Ergo, HDFC Asset Management, Growth Finance, and so on and so forth. So if we were to look at the listed investments, and there are really only two large listed investments, which is our subsidiary Growth Finance and of course HDFC Bank. And if we were to look at the market price of the share of those shares on 31st of December versus the carrying cost, the cost at which these investments are reflected in the balance sheet, then the unrealized gain or the unaccounted profit on those investments, listed investments alone, would be to the tune of 33,379 crores. In addition to that 33,379 crores, there is of course an unrealized gain on the unlisted investments, but that value would really be ascertained only when we list these companies or sell some stake in these companies over a period of time. The book value of our share on a standalone basis, and this is a standalone number, stands at 186 rupees a share. But that 186 rupees a share does not capture the value of our investments. If we were to include only the listed investments and add that unrealized gain of 33,379 crores to the shareholders' funds, then the adjusted book value per share number would go up to about 400 rupees a share. And even that 400 rupees a share does not capture any value for our unlisted companies, unlisted subsidiaries. If you further take that into account, then the book value per share number would be significantly higher. When we look at capital adequacy, we have...
All right, that's the management of HDFC detailing their earnings. We need to take a very quick break, but we'll be back in a bit with your stock, Sauda Akka.
MCX Stock Exchange, India's new stock exchange, presents Mid-Cap Radar.